Stocks. This is our weekly Power Hour episode. I'm one of your hosts, Ryan Henderson. And as always, I am joined by Brett Schaefer. We've got a lot to discuss. Digital lawnmowers. Brett, have you ever heard this term?
Not until this week, Ryan. Excited to explore this analogy. I don't know. You're gonna get into it. It's a fun thought exercise, and it might seem weird to any listeners, but I think it can help explore stocks to buy, stocks to not buy, fields that might be potentially good investment opportunities, and areas that might be poor performing investments over a 10-year period. So excited to discuss that and much more today.
Yeah, we're going to be digging into some of the businesses that we think are at the most at risk of being disrupted by AI. Little tease there. And then I want to revisit Match Group, an old flame of ours. I don't believe either of us own shares today, but it's gotten increasingly interesting over the last, call it, quarter. And then I have a segment called How Crazy is Palantir? And I'm putting some numbers behind it. So not just blank thoughts, not just headline uh, multiples. We're going to go through some of the numbers and scenarios to talk about it. And then you've got a whole bunch of notes on AI. So we're going to get into all of that. But before we do, we want to talk about our friends at Interactive Brokers. Interactive Brokers is a professional's gateway to the world's markets. Interactive Brokers offers commissions starting at $0 on US listed stocks and ETFs with low commissions on other products, and there are no added spreads, ticket charges, or account minimums. Clients in over 200 countries and territories trade stocks, options, futures, currencies, bonds, funds, and more on 160 global markets from a single unified platform. Clients earn interest rates up to 3.83% on instantly available cash and pay margin rates up to 53% lower than the industry. You can also earn extra income on your lendable shares, and IBKR's powerful award-winning platform helps every level investor succeed from beginner to advanced on mobile, web, and desktop. When placing your money with a broker, go with the broker you can trust. Make sure your broker is secure and can endure through good and bad times. We use IBKR here at Chit Chat Stocks because it is a phenomenal platform for international investing, and you can use them too by heading on over to ibkr.com. Interactive Brokers is a member of SIPC. Where do we want to start, Brett? Digital lawnmowers?
Well, if we're going to do digital lawnmowers, do you think it'd be best to do the AI updates of all these companies first? Because then people can hopefully get a better understanding of what's happening in this field, how it's really disrupting the computer programming space. And I think they are related. So you're nodding your head. I'll get right into it. We have three different companies: Alphabet, OpenAI, and Anthropic, which would be three of the leading AI companies in the world besides FinChat, right? They're number number four. Actually powered by some of these companies, I think, but I guess you don't really need to disclose that. First, let's talk Alphabet or Google. We'll interchange them for their name. They had their annual Google I/O event. There was a flurry of announcements. First, I would say that founder Sergey Brin was there. He crashed a talk. He said he's back, quote, torturing workers like Demi Hasibis, the guy that runs DeepMind. Can't pronounce his name. He was actually helping with some of the product demos, working on it with people, and really just embracing all of the AI work they're doing. Now, you're a shareholder, Ryan. Does that make you optimistic that Brin, one of the smartest people of the last century, is back working with Alphabet?
I like the idea that he was so excited by AI and what's going on that he felt encouraged to come back. Yeah, I think that makes me it makes me optimistic that they're treating this. I don't think he'd come back as like a we need to defend our mode or something type of like. I don't think that's what inspires him to work. So the fact that he wants to come back tells me he believes they have the ability to do something really great with the new technology.
Okay, and let's get in. Yeah, I agree with you there, even though I don't own the stock at the moment. But let's get into some of the products because they, maybe for better or worse, have a ton of products, and it's really hard to keep up with, even as someone who's trying to analyze it from an investing perspective as a consumer. I can't keep up at all. Let's just go through them. They have a prototype product that has copied Meta's Ray-Ban glasses, essentially very, very similar use case. They are bringing AI overviews on Google search globally. Here's a quote from their product announcement. Google has announced a new AI subscription plan with access to the company's most advanced models, and it costs $250 per month. The AI Ultra plan also offers the highest usage limits across Google AI apps, Gemini, Notebook LM, Whisk, and its new AI video generation tool, Flow. That's a lot of names for products, and they all don't actually relate to what they do. There just seem to be random names, so it's very, very hard to follow. I'd assume that this is solely for professionals, where you are a company that's in either design or coding or what have you. You would pay for this subscription for one of your employees to kind of hopefully supercharge their work. Let's just go through the rest of the list. They are now doing auto translate in Google Meet, which seems pretty cool. Here's a quote from the press release. This time last year, we were processing 9.7 trillion tokens a month across our products and APIs. Now we're processing over 480 trillion. That's 50 times more. So it seems like they've gotten 50x growth in usage. I'm going to be honest, I still don't know what this token crap is for AI, and I'm not sure Ryan does either. But let's move on. They have a early research prototype called Project Mariner that is an early step forward in agents with computer use capabilities to interact with the web and get stuff done for you. Now, this seems cool. It can help with managing your calendar. It's kind of integrated within all of your software tools that Google has, and I could see there being use here. And I guess the way I would sum it up, and we didn't even talk about what's going to happen and integrate with their other hardware like Google Pixel, which is competing, I guess, with the iPhone and Samsung. Although Samsung on Android is a partner and a competitor. My question is, are they basically trying to compete with everyone?
Yeah, I mean, I sometimes think it's a little counterproductive to have these events where you announce everything at once because it almost feels like there isn't one big takeaway. Whereas Meta, I think their last event, the big takeaway was the Ray-Bans glasses. Like there's something to create some buzz. When you have a million products you launch, it doesn't really create any buzz around all of them. They have enough distribution that I don't think they need buzz from events, but I like the idea of this. I like the high price point for some of the developer tools. I know from what I've heard, uh, Gemini and some of the AI capabilities from Google are really well liked in the development community. I agree with you. Don't know what the tokens means, to be honest, but nice to know that usage
Sounds
is
like
going up.
usage. It seems, yeah, like usage is going up. Here's what's weird, Ryan. I have the Pro Gemini plan, $20 a month with this Google One thing that they offer that bundles stuff together. But I don't really use it. I've only had it for a month, so I guess I'm going to try it out more. Am I just not getting it? I still go to Google search and I like reading things from actual humans, but maybe I'm just old school now.
Yeah, I don't know. I have been using ChatGPT more and more lately, as opposed. Well,
You should be on Google, Ryan. You're a Google shareholder.
I know it's actually left me slightly concerned because there's a part of searches that just doesn't need to be filtering through articles and reading things. And sometimes ChatGPT is really nice for that.
But why not just use Gemini, Ryan? Come on. You got to be supporting your shareholder base.
I've gotten bad outcomes with them before, and it kind of deterred me. Maybe it's gotten better, but some of them have led me astray a couple times. The I don't know. I guess I could shift my behavior. I really don't care which one I'm using. My working assumption here is that they're all using the same available public information. So how they pull it is I don't really
Well,
care too much.
OpenAI illegally takes Alphabet's data, but that's a whole nother topic. I'd say Alphabet in this case has the most data because they're the only ones that has access to YouTube legally and all this other stuff, your Gmail and what have you. Yeah, other companies can maybe try to train on that if they want to, but technically they're not supposed to.
See, yeah, I don't know. Nothing from this takeaway tells me I need to go buy something from Google. The Google Meet auto translate is nice. I think they've had this technology on the live translate on YouTube for quite a while. So it makes sense that they're able to port this over. What about OpenAI? Any big announcements from them?
Well, it seems like they are buying Johnny Ive. They're actually buying his company for $6.5 billion. And then they made a strange introductory hype video with Ivan Altman at a bar in San Francisco. It was strange. I don't know if you watched this. It was almost like they were introducing, like they were about to get married. It was like, oh, we're launching our our wedding. Come join. It did not feel corporate whatsoever, which is not bad. It's just a bit strange to make a very nice looking documentary on a acquisition announcement. Now, the company they're actually buying, now this is OpenAI, and they are buying an all stock deal for $6.5 billion, a company called IO, which is run by Johnny Ive, I think, and probably some other designers. And it has 55 employees, Ryan, which I think maths out to over $100 million per employee. Those got to be some very valuable employees. Here's a quote from the Wall Street Journal around some sourcing on why they are doing this. OpenAI chief executive Sam Altman and Ive's design firm Love From have been working on a new device that will move consumers beyond screens, according to people familiar with the matter. They have been collaborating for 2 years on a closely guarded project, considering options including headphones and other devices with cameras, the people said. First, I don't want more cameras filming me. I hate it. I don't like it. The Meta Ray-Ban glasses, I want to take off someone's head and turn them off because it's just, that's a personal gripe. But from an investing perspective, does all of this get you concerned about Apple? The guy that designed the iPhone, like the physical part of it, and I think the MacBook, some of the best products in Apple's history, has decided to leave the company and work for this startup. Uh,
I mean, hasn't he
this
been he's been away from Apple for a little while though, no?
Well, yeah, but he's been working this is just a next step in the relationship. He's been working with Altman for years now, along with other companies like Airbnb. I think it's more of a consulting service. This, along with all of the stuff that Google is adding to Android, it's not gonna move the needle this year, but over a 10-year period, you have to factor this in. Apple seems dead in the water on all of this stuff.
Yeah, I mean, it feels like all AI news, we kind of turn and say, this has got to be harmful to Apple.
Well, I mean, yeah, that's the logic.
But at the end of the day, they are selling more iPhones.
No, they're not.
We're selling a flat amount of iPhones,
Selling
a stable
they're selling
amount.
less every year and charging more for them.
Yeah, I guess revenue's stable, but I yeah, I guess they're kind of being left behind by these announcements. I still am skeptical that any of these wearable, like interactive hardware types are going to be the new form factor that really displace the popular hardware from today. I don't know why. I mean, maybe it would be more convenient to have smart glasses, but it's just people continue to use phones. You know, we've been talking about all these different form factors like VR and all the headsets and
I
all
agree.
these new
Yeah.
headphones for a while, and there's yet to be anything that's really displaced the iPhone or smartphone in general. So
They keep trying to push it on consumers like us, and when you had a product like the iPhone or other smartphones, not just that one, you didn't really need to try to convince people to use it. They're like, "Oh, this is awesome. I'm gonna use this." And we haven't seen anything like that since, which should be good for Apple. I would say there's still not something out there where you go, "Oh, this is obviously the next step and everyone's gonna switch from smartphones." However, if that is correct, Apple is in serious trouble. I'm just not sure, and I think I agree with you that over the next 5 to 10 years, is that gonna happen? I just don't see anything out there. Like, people talk about Meta Ray-Bans disrupting smartphones, and I just don't see it.
Yeah, I'm very skeptical that that would be the case. It, in general, yes, if something were to get, you know, become sort of mainstream, then yeah, I think Apple's the most at risk. But there's other reasons that I think Apple's a bad investment beyond that. And frankly, there's probably other reasons that I would care more about if I were an Apple shareholder than this stuff. The thing I did find funny is Apple just announced that they're planning some smart glasses launch of their own in 2026.
Mm.
That would be a concern to me, is if you start to feel like they're just playing catch up and trying to replicate what everyone else is doing. Like if you have another absolute VR blunder, like what they had with the Apple, what are they called?
Vision Pro,
The
the
Vision
ski
Pro.
goggles.
Yeah, I mean, you don't want them to just keep trying what other people are doing and have zero success. On the one hand, though, it, it is okay if they're waiting to see some proof of concept or some proof of like success. Like if that's what they're waiting for, they want to see that there's actually some traction here. Like you want to let Meta spend billions on VR before you try it for yourself. I guess I'd be okay with that because hardware, all in all, I think their brand's going to typically win out, and people will give it a try if they are experimenting with other form factors.
Right. Yeah. It's just the risk that, and it's probably not there today, that they fall behind technologically too far, which you're not going to go. If they said we only have the technology of the 2010 iPhone today, no one would buy it. Let's see. We have a couple comments on this. Says, do you guys think Apple should just sign a deal with Google to use Gemini as their AI tool? Probably, because then that mitigates some of the tech risk, and there might be the risk that the Google search payment goes away. So that could be a way to replace this. Let's see. Comment here says the eyeglasses aren't going to kill Apple. The Pixel with Gemini is going to kill Apple. I'd be skeptical on that on a short time horizon, but on a longer time horizon, maybe. And it says all you need is one generation where Pixel or Samsung is clearly ahead of the iPhone and the entire feedback loop flips. They've been ahead technologically for a while, and I think it really needs to be a bigger advantage. The phones are better. They have all these products that are announced at Google I/O every year, and it doesn't matter. It needs to be a very, very large gap, I would say.
Yeah, it's just a pain to switch operating systems. I mean, I don't think you're going to get unless iPhone becomes unaffordable, which at this point it's really not unaffordable. You could save money, obviously, going to some of the Android providers.
Not really. I don't think that's a thing because the Google Pixels are like the same price.
I just don't see a lot of people switching. They got to be way behind, and
There has to be some product or group of services or whatever on there that makes your life so much easier, and we just don't see it yet.
yeah, there is
All
a
right.
bunch of questions around China. I think we should get to that in a sec. I already know what your guess is. I can guess what you're going to say, but I want to talk about this thing I saw this week: digital lawnmowers. And I actually thought this was a really cool term. And apparently, there was, I guess, anything else on the AI announcements from this week?
There's some new announcements from Anthropic. They have Claude 4. So many products, but I didn't think anything crazy for them. I guess they're doing $2.2 billion in revenue. They're going to charge. It's more enterprise focused, but I think it just illustrates, maybe this will relate to your topic, how the AI tools are disrupting computer software engineering. It's about the extent of my knowledge of that as we know it. And it's just a huge paradigm shift that may be applying to other industries.
All right, let's talk digital lawnmowers. So there was apparently this secretive, in air quotes, putting that in air quotes, long short fund called Scout Capital. I love when people make themselves like a secretive fund when, like, I don't know. You're just investing in I don't
It,
securities. There's
yeah,
nothing like it's not
it
like you're
makes people
building some inner like disruption that you need to be in like shadow mode for
right.
where
It's like
no
it's
one
not like
sees
you're
it.
Johnny Ive. Yeah, it's also rounds in with my favorite. Well, he's one of the deepest thinkers I know. Okay, thank you.
Yeah,
Very
whatever
nice.
that means. So anyway, It's called Scout Capital. Apparently, they had really good returns, and someone published a snippet from, I believe, one of their investor letters on Twitter this week. And I'm going to read the full quote because I think it's really good. It says, "In the fundamental equity camp, we are focused on the quote digital lawnmower." They also put in parentheses, "This is a proprietary Scout term." An ugly process in which new digital habits, email, internet, etc., destroy the non-digital business models. We believe there are still a host of large businesses out there in the world that have not yet fully felt the effects of this transition, usually as a result of some kind of temporary delay or buffer effect. We have focused on members of this set that combine operational leverage with some financial leverage. This is more common than one might think, as return-seeking investors have layered debt onto companies whose growth rates have slowed, not anticipating the potential quote-unquote tipping point at which slow growth turns into rapid shrinkage. We are attempting to build on our success from prior shorts in the yellow pages and newspaper sectors. So, to kind of summarize this a bit, they use this mental model of digital businesses or digital habits disrupting non-digital habits
So
as
what's the lawnmower? Like why what's lawnmower? How does that relate?
I believe it's like the digital habits are kind of mowing over the past, or like cutting the past non-digital habits.
Okay.
Uh,
I understand what you mean, but yeah, the lawnmower might be a
Whatever.
stretch.
But I think it's a fun concept. So they use this as a way to identify good companies to short. So it's usually the newspapers are a perfect example. Local newspapers, this is something that was obviously disrupted by the internet, but not only do you have these non-digital businesses that slowly get their customers taken away, but oftentimes they have operational leverage. So as their revenue shrinks, their profits will shrink even more, and financial leverage. So they've had a nice successful business model for a while. They've layered on some debt, and because they think it's very predictable, or they want to juice returns, and now this digital business comes along and it really starts to crush them financially. Few examples I can think of, historical examples, would be the internet disrupting local newspapers, the internet disrupting phone books, Visa and MasterCard disrupting cash transactions and checks. So some of the companies that I think were affected by that are like, I don't know, maybe some of the brick and mortar bank branches, maybe like the check. Who is that company? Matech Systems, I think, that did like
The
the check photo
photo.
technology.
Yeah.
Look it up. Anyway, Spotify / music streaming disrupting the CD business, something like that. I'm sure there's more that you can think of. What companies do you think are at risk of this today? Are there any digital habits you can think of that are breaking some non-digital business models right now?
Okay. I'm going to save the AI ones because you have a follow up there. We actually have a very good comment. Not actually, we have smart audience, I would say. Telcos could be an example of this. Lots of debt and mature. I guess what he's saying is there could be disruption from the satellite internet providers and all that good stuff. Starlink, Project Kuiper. That is, yeah, potential there. Another example would be the cable bundle, the legacy media players, which have done quite terribly, even the ones with good brands like Disney, compared to the video streaming services that have totally disrupted that market. What would I add here? The remittance players, digital money transfers such as Wise and Remitly. Look at Western Union stock. It has done absolutely terrible. I don't know. It might be not a bad bet today, given that it's actually totally wiped down its dividends at 10%, but who knows whether that dividend's sustainable, but it actually has a market cap lower than Remitly as of this moment. And I think that's a clear example of this happening. You saw a lot of this with smartphones coming on and getting popular in countries around the world. Uber, another good example versus the taxi networks, although I don't think there was any stock to invest in from taxi wise. I think maybe today, and this one hasn't turned out too well, I don't think, but I don't follow the sector that closely, is when you have online shopping, you have, the infinite shelf space, and you have a totally different game to play. Where back in the day, if you were a large CPG company and you got the best shelf space at the grocery store or whatever place people were buying your products, and then you advertised on television, you almost built a monopoly that was very hard to break through. And now there's all of these upstart D2C brands that can try to disrupt and take market share. This could be for not only, consumer packaged good food, but all the way over to apparel. And I don't know if those are the best industries to invest in, but I think those are some good examples as well. And then we're going to talk about AI. I think there's some potentially other ones there as well.
Yeah, I'm not sure when the investor letter was written. I would say at this point, you've gotten to the it feels like most processes or human habits have generally gone digital for the most part already. So a lot of those non-digital business models have already sort of been broken, like the yellow pages, the local newspapers, the cash transfers. Like I guess Western Union's still around, but um, those business models for the most part have really struggled. I think we've gotten to the point now where we're even seeing more digitally savvy companies, or in this case, AI concepts, AI businesses disrupt digital businesses as well. What so this kind of poses the question I wanted to talk about. What businesses do you think are at the highest risk of being disrupted by AI? Because we talk about the winners of AI, and it's easy to speculate and all that. This goes back, I think, to I think Buffett has given this analogy, which is when the automotive boom occurred in America, you could have bet on a whole bunch of automotive companies, and you could have given this beautiful picture where it's like the whole country is going to have roads in the future. There's going to be million cars driving on these roads in the future, and automatically people would think, well, you got to invest in an automotive company, but actually they did not generate good returns for investors. What you should have done, he says, is bet against the horse. It, because the number of horses in America dropped drastically as autos became more popularized. So who do you think is sort of the horses in the, I guess, AI, if we want to use those terms, revolution, or the AI business models moving forward?
One concept with AI that I think makes sense is you are at risk if you have commoditized supply. I've heard this before. I think I may have heard it from a interview this week with the product lead at Spotify, where they've been thinking about how they have some commoditized supply and they have to figure out how to make themselves differentiated in an AI world. And the reason why I think this makes sense, where if we get more of these not search queries, basically conversational queries with AI agents, chatbots, what have you, and they go do a lot of tasks for you and return you results that are more comprehensive than a Google search. Is if you have commoditized supply, you have no pricing power, and it doesn't matter what your UI is, your UX layout is. I think an example for me would be someone like Booking Holdings, where they've dominated through very, very strong execution versus the likes of Expedia and some of these other online travel agencies. But if I can query Gemini or whoever and say, look, find me, I have some specific details of where I want to stay and what I want to do on this vacation. Now go find me this hotel room at the cheapest price and come back to me. If you have commoditized supply, it doesn't matter where the agent goes if it's the same hotel room. But if you're someone like, I know people don't like this company, Airbnb, with unique supply, it might work a lot better. Car rental companies, which have kind of already been disrupted, might be at risk here. I would say airline bookings could also be interesting, but they've done some things with their membership programs and credit cards to help mitigate that risk and try to make themselves differentiated. Although, if y'all have credit card programs, that doesn't matter. And that's a little bit different than the AI world. I think possibly music and video streaming, but I still think people like listening to humans. I don't. That's a little bit. There's something I'm not certain about there. It's hard, and I'm not. It's hard because if you can find these companies, you can make a lot of money, as Scout Capital has done. I don't. I have trouble coming up with specifics besides booking that came to mind, but I think commoditized supply is a good concept for what would struggle during uh, if AI goes mainstream and everyone uses it and replaces Google search. Now that we know Google search, they're trying to disrupt themselves, but yeah. What do you think, Ryan?
Yeah, I like that theory that commoditized supply is going to be the most at risk. One example that comes to mind for me is Chegg. I had a friend who he's kind of in the perfect situation to look at this because we were in college when Chegg was probably at its peak. And for anyone that doesn't know, Chegg is basically just a community sourced answer machine to
Do
homework.
homework and yeah.
So,
Someone
if you
does the problem already, you just copy it.
right. And it's this repository of answers. When we were in college, everyone I knew was either on Chegg or using it in some capacity, whether they had their own subscription or were borrowing. My buddy is going back to school, and he said there is his words, Chegg is screwed. It like AI has just become the answer machine using a lot of that
Yeah. I mean, we knew
answers
this.
out there.
Yeah, we've known this. Stock's down 99%. I think it's
Is it?
yeah. I mean, Jake's been done for a while.
I heard or I saw that they are suing Google
Gotta get
because
desperate.
and it kind of makes sense is that they are using Chegg answers in Gemini responses. So maybe there's some validity to the lawsuit, but yeah, I could see how they've just been crushed by AI. The other one that we've talked about a little bit, enterprise software. I think Adobe is at risk. We've talked about it on this show before, and I wasn't really sure. But the more and more I think about it, AI seems to be kind of hurting them at the edges. Canva has really, I did not realize how big Canva was. And aside from the high end customers, the ultra high end enterprise customers, I think AI is going to do a lot of the heavy lifting for people that want images, people that want presentations, people that want, I don't know, the stuff that isn't like super detailed like you get at the enterprise level. So they'd be on that list for me as well. Maybe
What about
Salesforce.
website builders? Traditional style.
Maybe, but it seems like the SaaS models from what I've seen, the SaaS content management systems, so Wix, Squarespace, Shopify, I think those are the biggest ones. Maybe I'm missing some, have kind of become the best AI website generators so far. Maybe I just haven't looked deep enough, but a lot of them have like really great AI build this website for me type tools.
Yeah, I think that is a good example of for anything that prior to now took, I guess, general computer science and software development and coding. Any of these companies are going to need to be proactive and just try to get ahead and know that there's going to be these AI tools that launch and we need to match them to retain our customer base. And I think presents all of these enterprise software companies at risk.
Okay, before we move on, I do want to talk about our friends at Blue Chippers Club. Blue Chippers Club, I was on a call yesterday, got to talk to a bunch of listeners, friends, and hear some new stock ideas from them. It is a club that was started by two friends of ours with the goal of building a tight-knit community of stock-focused investors. You can share, break down your portfolio, pitch stocks, receive feedback, participate in weekly calls if you'd like. I really do like this idea, and it's why we're promoting it here on the show. And if you're interested in checking it out, it's bluechippersclub.com. The link will be in the description. I really recommend giving it a look. That's bluechippersclub.com. Speaking of unique supply, Match Group.
That's
the
not unique supply.
You don't think so? I guess Bumble has probably some of the similar supply, but the dating apps in general, I mean, they aggregate supply that's somewhat unique to their niche. No,
Somewhat.
would you say Hinge's supply is unique?
No.
Oh boy. All right. Christian Mingle, that kind of thing. That's got
That's
unique supply.
yeah, sure. That's unique supply. Yeah. But that's small potatoes.
Yeah. All right. Well, speaking of Match Group, I wanted to talk about this because it came up kind of on a screener I ran for buyback yield. Match Group right now has bought back $833 million in stock over the last 12 months. That buyback pace is currently 11.4% of their market cap. They have spent $274 million on stock-based compensation. Now, that was the one reaction I got was, okay, well, how much are they spending on stock-based comp? So still, even if you deduct the stock-based compensation, they are spending nearly $600 million net reducing share count, and shares outstanding over the last year dropped by roughly 8%. We have a ugly history with this company, or at least I
Well,
do.
it's been yeah, we bought it at a higher price and it didn't do well, I guess. Put it in plain terms.
Would you ever own Match Group again? And what would the catalyst need to be to get you to become a shareholder?
Yes, I would. I like the new CEO. I think Zillow he worked at Zillow, I guess, and did well there in building that product and getting usage up. I would worry a bit about capital allocation given what that stock has done. But I like what they said. I've read one of their transcripts where they said they're not going to go on an acquisition spree. That has hurt them in the past. So I like this new management team. I would bet on them. The Raskoff, Spencer Raskoff is the new CEO's name. What I need to see, and I wish they would disclose this every quarter. Honestly, just give us monthly numbers and stuff like that. Active users on Tinder need to grow globally, or at least stabilize, because it just keeps going down, and eventually the network effect is going to collapse. So without that, I'm out. But
Do you
that's the one
think
thing.
Tinder users will be higher or lower in 5 years?
Depends what products they launch. There is if the product doesn't change, it'll be lower. But if they truly improve the product and understand what the both sides of the marketplace need and want out of not just one age group, but all age groups that they're trying to serve and in all regions, just much easier said than done, then I think the users will grow. So things I would be looking for is just ways to get people of all age groups on there, dividing between different types of relationships people are looking for, catering to local markets, catering to local languages, and making sure the most important side of the marketplace, the female one, is actually enjoying their experience and actually messaging people and finding people to go on dates with. Because if you alienate the way these dating apps work, we had other topics to get to, but it essentially makes it so 70% of the guys on the platform get nothing. And when that happens, they can pay once, but then they get frustrated. So when that is happening, you're just going to reduce the amount of supply because people are going to get sick of you and leave. And it's kind of this not winner takes all, but just this huge skew of who is successful and who enjoys using it. And when that happens, people are going to be upset. So fixing all of these issues is not easy, but if they work towards that, I think Tinder users could grow. And the stock would definitely be a buy.
I feel like just if I had to pick one, Tinder would have fewer users in 5 years.
If I had to pick, yeah, I agree. I agree with you.
Okay, I wanted to talk Palantir. Do you want to get to any other topics first, or should I just run through these numbers for you?
Palantir? I feel like we've already done this topic.
Maybe, but I want to run through the like best case scenario and what it would mean for shareholders.
Yeah. Maybe I'm thinking I write this thing for the Motley Fool all the time since it's a very hot stock, and I guess I go through this math. Yeah, I guess we can go through this. Yeah, I just got some stuff, so maybe make it quick-ish.
Okay. Palantir is now the 25th largest company in the US by market cap. I believe they are the largest pure B2B SaaS company in the world, ahead of Salesforce. And so the price to sales is 91, but I actually want to put that into context. So to do that, if you're a Palantir shareholder, which I doubt that many Palantir shareholders actually listen to our show, but if you are, I'm going to compare them to Salesforce. The reason I'm comparing them to Salesforce is because Salesforce has had the best growth rate I could find for a semi-large business over the last 20 years. So if you wanted me to compare them to Amazon, the valuation would look even more insane for Palantir. If you want me to compare them to Microsoft, Google, it'd be even more insane. So Salesforce grew at a faster rate revenue-wise than all three of those businesses. Regardless of whatever you think of Salesforce today, for the last 20 years, they have been the absolute software darling. These are the types of results you dream of as an investor, what you've gotten with Salesforce over the last 20 years. Those are dream returns. So let's imagine that Palantir has similar success from here. That would mean that Palantir grows its revenue by 28% a year for the next 20 years. So talk about like that would be a dream come true for Palantir shareholders. If they did that, they would be earning $400 billion in revenue in 2044. Now let's imagine they had the same operating margin as Salesforce. This is where you could maybe, give some wiggle room. You could say they'd be a little higher than Salesforce, whatever. But I think
Also, $400 billion in revenue, for people that don't know the context, is like Apple and not even Microsoft. Apple, Amazon, Walmart, Alphabet's close to that. There's like 3 companies globally that do that.
yeah, and there's no B2B software companies that do that. The let's get to the operating income. So imagine 20% operating margins on $400 billion in revenue. They would be earning $80 billion in operating income in 2044. Yes, I'm modeling out to 2044. That is up 200x from what they're currently generating. So, and if you said in 2044 they traded at 15 times operating income, which I know that sounds crazy from here, but it's really not that crazy for a business to trade at 15 times operating income. That would mean after a 200x in operating earnings, you would have generated, wait for it, a 7% annual return. Are those the returns you would hope for if you are forecasting earnings to go from 400 million to 80 billion? Would you want a 7% annual return?
Yeah, I mean, I guess you're not probably including capital returns to shareholders, but look, the stock is a great short. It is. It's not going to work. Cisco 2000, Shopify 2021,
This puts Shopify 2021 to shame.
sort of. They were at 60 times sales.
This is
Cisco,
91.
yeah, I guess it's beating them. Snowflake at their IPO. There's some others out there. There's some of the cannabis names, the 3D printing names, although that was more of just shitco industry that was getting a lot of hype, similar to the quantum. And have you heard of the electric air taxi stocks too, Ryan?
Yeah, I've heard.
Yeah. That's the 3D printing of today. Don't worry, it's going to revolutionize travel. But back to Palantir. Yeah, it's not going to work. It's not going to work. It's gone up 10x, but it's not going to work from here. No matter if they could get the entire defense software budget, it doesn't matter. They could sign with every Fortune 500 company for a $10 million deal. Doesn't matter. They're
Yeah.
not going, the stock's not going to work. And you're not even including SBC.
Yeah, let's assume that's equal to cash return to shareholders.
If any look, here, let me challenge any listener, because I know there's some Palantir lovers out there. If you if someone doesn't like a stock you like, that's fine. There's plenty of people that don't like the stocks I like. I don't care. I can still be friends with them. But second, I would be willing to make a nice bet. Loser donates to the charity of the other person's choice of, say, 300, 400. I don't know. We don't have that much money. A couple $100. uh, 10 years from now, if Palantir generates maybe positive returns going forward, I don't even need this to match the market, because I have high conviction, like extremely high conviction, this is not going to work over a 10-year period.
Yeah, I just want to run a quick screener to see how many companies have $80 billion in operating income. That would, I believe, make them maybe the most profitable
In the whole
company.
world? No, Microsoft is higher, Apple higher, Alphabet higher, Nvidia higher, Amazon no, but probably shortly. Facebook, I don't think so, or Meta. Tesla no.
It's,
TSMC
yeah,
close.
I don't get it. Like, the absolute best outcome
Is flat.
for
The
the,
best
yeah,
outcome is like you're flat over 10 years, something like that. I mean, we have a comment here from Patrick says, "What is even the TAM for Palantir? How many customers can you really have?" Great point. Good point. It doesn't not have nearly. I mean, it's probably something similar to Salesforce. $80 billion in revenue is going to be a huge stretch.
all right, let's get to your topics. They're maybe a little more optimistic than mine, so let's
Well,
jump to
maybe
them.
not Mike
Well, maybe
Burry.
not.
We had to talk Mike Burry's portfolio. What do you want to do first? CoreWeave earnings, bond price collapse, or Michael Burry's new short bet?
Let's do Michael Burry.
Okay, well, his 13F came out. Remember, these portfolios don't include pure shorts or international stocks you buy outside of U.S. exchanges, and it was as of the end of Q1 2025. And remember, Liberation Day, one of the funniest days in U.S. history, was April 2nd. Now, according to the 13F, which is 2 days before Liberation Day, he owned simply Estee Lauder as a stock. He had a large put position on Nvidia, as a large put position on Chinese stocks, and that's about it. So he was short Nvidia and Chinese stocks. I have no idea how he traded it, because if he just held, it probably wouldn't have done too well. We don't know. But Burry seemed to be quite well positioned heading into Liberation Day, although Nvidia, I guess, didn't do that badly. Um, do you think he is making another macro bet due to the tariffs?
I don't know. He's impossible to read. Like, every single 13F is just 100% turnover. So it's totally all new investments. You don't know, like, what the put prices are, the strikes are. You don't know.
Don't know if he
There,
has a giant actual short position or international portfolio. Yeah, let's
yeah.
see what he got out
So
of. I should have pulled that up. I think he just
all
he
on FinChat, which is a
uh
good time for us to plug FinChat. If you want to follow super investors, they're all on there.
That is
Michael
true.
Burry.
That is true. What's weird here is that he was long a lot of the Chinese stock ADRs. Baba,
Yeah.
Baidu, Pinduoduo, and then he just sold and then bought a bunch of puts on them.
He still owns Pinduoduo, though.
I don't think so. I think that's incorrect.
Oh, is that a put? That's a put. Yeah, he sold out of Alibaba entirely, Baidu entirely, JD.com entirely. I don't know. Maybe he just keeps up with Chinese. Maybe it's a bet on Chinese macro.
Yeah. Who knows? He's bearish. It was interesting to see that. Obviously, it turns into clickbait, something you can write a nice Motley Fool article. Big short investor, is telling the market something, blah, 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 blah. Yeah, but I don't know either. The man is not afraid to make a big bet,
No, obviously, if the movie says anything, obviously
though.
not.
That's true.
The
Let's talk CoreWeave, huh? Now, this is another AI related company.
Sure. I saw something this week that was a meme of like the Nvidia investment in CoreWeave, and it was just like
It's the
you
Always
know,
Sunny,
you know
Patty's
this,
dollars.
the surge protector, like uh,
Oh, yeah, yeah.
it was just plugged into itself.
Yeah.
Yeah, very circular.
Yeah, it's, anyone wants to understand some of these venture capital and AI deals and honestly, a lot of the economy in general, watch that Patty's Dollars episode on Always Sunny, but CoreWeave, for people that don't know, it's kind of an AI-focused cloud provider. They almost take on excess capacity from the cloud providers. They just buy a bunch of NVIDIA advanced computer chips and try to help people match supply and demand, I think. Honestly, I don't know. But they buy up a lot of servers. They are investing a ton in CapEx, and you'll never guess it, but CoreWeave management says that they delivered an, quote, outstanding start to 2025 on multiple fronts. I've seen companies that are about to go bankrupt say this in their press releases. It's it's ridiculous what the corporate speak is, and it makes me just not even want to read conference call transcripts anymore. Let's look at the numbers though. $981 million in revenue, up 420% year over year, so growing like gangbusters. They have a slight operating loss, $264 million in interest expense because they're taking on a lot of debt to buy up all or build all these data centers. 1.3 billion in negative free cash flow, 7.5 billion in negative free cash flow over the last 12 months. My question for you is why does this company need to exist? And maybe more
I don't know.
specifically, when supply catches up with demand from the cloud providers and they don't need to go to the CoreWeave for extra services, why would they still go to them? I just don't understand.
I have zero grasp on the business model, so I couldn't tell you.
Well, it's a
I
cloud.
will say,
It's like a competitor to AWS.
I don't, yeah, do they provide any like niche use cases that serve customers better than the major cloud providers?
Well, I couldn't tell you, but I'd guess no.
If they do, then maybe some customers stick around. I don't know. But what I will say, that quote you shared, an outstanding start to 2025 on multiple fronts. There is no more useless quote than the first quote you will read on a company's press release.
Yeah,
That
just skip it.
it is always the most meaningless word salad you'll ever read. So I
Yeah.
really encourage you to just never read it.
Yeah, yeah. Oh, yeah, yeah. There's a lot of yeah. You gotta filter through a lot of corporate buzzwords on those earnings calls. CoreWeave is, I guess, turning into a battleground stock. Now, Ryan, don't look it up, but I want you to guess CoreWeave's market cap.
10 billion. No, 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 sorry, 50.
Yeah, just about right. 48 billion. This is either going to be a fantastic long or a fantastic short, and I can't figure out which one it is yet.
I can't imagine it's a fantastic long. There is
Yeah, I think it could be a great short. I mean, a lot of free cash burn. That's a lot.
it's wonderful to envision the companies like Uber where they burned so much money pre-IPO that you kind of think, well, that's just a part of it that you'll see the operating leverage later on. That does not apply to most businesses. And the amount of companies that have tried to copy the operating losses of some of the winners that have actually just ended up going bankrupt is probably really high. So yeah, anytime you see $7.5 billion in free cash outflow on a company doing what, a billion in revenue, like red flags should go up everywhere.
I agree, especially when you're riding a, let's say, precarious roller coaster that is climbing and climbing. You don't know whether the cycle is going to hit a downturn. Can we talk, Ryan, bond prices?
Sure.
There has been a
You know
lot of
what?
panic in bond prices. A lot of listeners actually wanted us to talk about this. Yields are rising, which means prices are going down. US 3 months 4.4%, 10-year 4.6, 30-year 5.1%. The TLT brethren like myself, not been a great week, although honestly, my cost base is like 80 in between 85 and 90, and I think it's at this is the long-term treasury ETF. It's at like 84, so losses haven't been that bad, but returns for bondholders since 2020 has been abysmal. Now, this is stolen from or shared from an anonymous account called Jake at Econompic on Twitter. Says long-term zero coupon U.S. Treasuries are down 60% nominally since March 2020. Now, you add in 20% in cumulative inflation to the mix there, and it has been a total wipeout for bondholders. Now, maybe it's time. Maybe now is a good time to add some. I don't know. Could be fine if you want to have some kind of quote unquote not cash and equivalents, but a little bit different in your portfolio. I don't know.
Does
Seems better. You actually get some yield.
does any of this have to do with the Moody's downgrade on
That's
US
what
debt?
people are asking about. Yes, I think so. Hard to tell for certain. So a lot of the pundits are saying. I think the reaction though on the yield is correlated to the likelihood that this new spending bill passes. So I think the fact that they're forecasting the deficits to continue in the United States, the bond market is getting very weary about that and doesn't like it. And that rising yields, I guess, in most simplified terms, means they just don't like what the spending bill is going to do.
It is so I saw, for context for anyone that doesn't keep up with the bonds like myself, the Moody's downgraded US debt for their credit rating from AAA to like AA1 or whatever the like second tier is
One
below.
down, right? Yeah.
Yeah, I think it's like a 27 tier rating system. So it's one tier down. But it's like a huge deal because whatever, it's been considered the risk-free rate for forever and has wonderful credit ratings. Now, I think 7 hours later, the US White House released a statement that said, "We reject Moody's credit rating." Did
That
you
is
know did
that
you
is
know that was
funny.
an option?
Yeah, that is funny. Then they just have a fleet of F-35s behind them.
I guess. I didn't know you could just reject it. Companies should start trying to do that. No, we
Yeah,
we reject it.
that is funny. I did not hear that. Um, yeah, that's wow, what a joke. The in general though, people hate there seems to be a lot of negative sentiment against long-term bonds. And given where the deficit is, I feel like they're gonna have to yields are gonna have to go up or sorry, down, which means prices are gonna go up. That's all I feel. And combined with, mortgage rates are back at I think 7%. Combined with the unaffordability of homes, I also think there is just a large incentive, with the government debt and making homes more affordable for young people. There's just going to be a large nationwide incentive to lower interest rates. And I think as a part of a portfolio, some, I guess, short is more of just cash and equivalents, but 10 to 30-year bonds, call me crazy. Seems like a fine time. Seems like a fine time to buy right now.
Yeah. I don't maybe. It
Why would it
yeah,
do badly?
what's the
If
yield?
if it gets worse, we got way more worse things to worry about than our personal portfolios.
What's the yield right now?
30-year, 5.1%, 10-year, 4.6%. That's yesterday, so
You know
good
what I
job.
think about a lot was when someone asked Jim Chanos what's the biggest mistake he ever made in investing, and he said not going levered long 30-year bonds in what was it, 1980,
2,
whenever the rates hit like 15%. The
1982.
Yeah, we're a long ways away from 15%, but
But it's not mathematically possible for treasuries to get back there. The country would hit it. The hyperinflationist would be right. I mean, it would be bad news. It's not going to happen. And again, as I say, if it does happen, call me macro doomer. Things are going very badly for the global economy.
what well, then let me ask you this. Do you think you can generate better than 5% returns annualized? Maybe even call it 7% annualized if you get price appreciation too. Uh,
Ooh,
then I if you're investing outside of bonds.
I don't know if that's the way I'd frame it. I think I don't. I don't know specifically to answer that, but the reason it can be part of a portfolio is generally, and I still agree with this. I know there's some people that say this is over, that correlation's done for, but if a recession hits, the Federal Reserve lowers interest rates, and um, the bonds perform well, as has been the historical correlation. It can give you a counterbalancing effect to buy some cheap stocks. So that would be the reason to include it in a portfolio. You want dry powder in a downturn. And I think treasury bonds, even if you just do short term, which again is just like cash and equivalents, that can give you a lot of flexibility. And given where the stock market's trading, don't think it's an untrue move.
All right, I think that's just about time for us. We didn't get a chance to mention it, but we use FinChat all the time here. And if you want to use our code finchat.io/chitchat, you can get 15% off. That's
A
the
lot of people
place.
signing up. I'm loving
Yeah.
those commissions.
Ton of people have signed up lately. I, I think people get a lot of value out of it. Honestly, it's like all the financial data you need as an equity investor. So recommend checking it out. But I think that's going to do it, Brett. Any other parting thoughts?
Well, maybe we can save it next week, but Jamie Dimon is bearish. So
Him and
another
Burry.
parting thought. It's been a bearish week, I guess. But thank you for everyone for joining. And Ryan, I guess I can hit the disclosure. We are not financial advisors. Anything we say on the show is not formal advice or recommendation. Ryan, I, or any podcast guests may hold securities discussed in this podcast, may have held them in the past, and may buy, sell, or hold them in the future. Thank you, everyone, for tuning in. These go live on our YouTube page, 5 p.m. Eastern Time, every Thursday. And you can watch the replays on YouTube or listen to the replays wherever you get your podcast. Thank you once again, and we'll see you next week.